SpaceX is preparing to go public, targeting a $2 trillion valuation. If that happens, it'll be the largest public debut in market history. This chart shows their private market valuation over the last 2 years. They went from $210 billion in July 2024 to an estimated $800 billion by the end of 2025. Now, they are pricing this IPO at $2 trillion. Demand for these shares is overwhelmingly driven by retail investors. People are eager to buy into Elon Musk's track record and his vision. Because of that demand, the underwriters are doing something highly unusual. They are reportedly offering everyday investors a 30% allocation of the total shares, rather than the standard 5 to 10%. On the surface, this looks like a rare opportunity to build generational wealth alongside the founders. But if you look closely at the math, you have to ask whether retail buyers are actually being set up as exit liquidity.
Let's be clear. SpaceX dominates global space launches and operates a satellite network that spans the planet. The engineering achievements here are undeniable, but a brilliant engineering firm can still be a terrible addition to your portfolio if you pay the wrong price. The question we need to answer is whether buying SpaceX stock at a $2 trillion valuation makes mathematical sense for a standard retirement account. To figure that out, we have to strip away the romance of colonizing Mars and look directly at the valuation multiples and corporate debt. If you buy a share, you are acquiring a slice of their core, tangible businesses, launch services, and the Starlink satellite internet network. These are highly profitable operations. Together, they generate an estimated $15.5 billion in annual revenue, operating with profit margins sitting around 54%. This waterfall chart breaks down a sum of the parts valuation model for SpaceX. If we calculate the fair market value of each segment today, $380 billion for Starlink, $258 billion for their AI division, $100 billion for the launch fleet, and so on, it totals roughly $1.25 trillion. To reach the $2 trillion asking price, you have to add a massive premium on top of that base value. Buying on day one means paying a $500 billion surcharge. You are paying today for flawless execution that the company still has to deliver over the next decade. That valuation also reflects a major corporate pivot. Following the acquisition of xAI, SpaceX operates as an artificial intelligence conglomerate. The pitch to investors is that combining rockets, satellite internet, and artificial intelligence will create orbital data centers and a global connectivity network. This graphic shows the financial reality of that trade-off. On one side, you have the profitable space margins. On the other, xAI brings a cash burn of nearly $8 billion over 9 months, plus over $17 billion in inherited debt. While the idea of space-based AI is compelling, buying the IPO means your capital is directly subsidizing a research lab that is currently operating at a massive loss. This comparison table shows how that $2 trillion target translates into market multiples. At that price, SpaceX will trade at roughly 125 times its sales. For comparison, look at NVIDIA's peak ratio of around 40 times sales. NVIDIA manufactures the core hardware that powers the entire artificial intelligence industry. Even at the height of its market dominance, it traded at a fraction of the multiple SpaceX is asking for. At 125 times sales, the stock is priced for perfection. Any delay in a rocket launch, any missed subscriber target, or any setback in AI development will be severely punished by the market. There is also a structural risk for new buyers. Reports indicate that insiders are considering removing the standard 180-day lockup period. Normally, a lockup prevents employees and early investors from selling their shares immediately. Without it, the people who know the company's internal financials best can sell their stock on day one, flooding the market and driving the price down. When you combine a sky-high valuation with the absence of a lockup, that 30% retail allocation makes sense. The market needs a massive influx of public buyers to absorb the shares that insiders will be selling. We have historical data on how these massive public debuts usually play out. Alibaba and Saudi Aramco both claimed the title of largest IPO in history. We also saw extreme hypes around the public listings of tech monopolies like Facebook. This line graph tracks the first-year performance of Alibaba, Aramco, and Meta. Across all three, you can see a sharp post-IPO dip following the initial launch. The pattern is consistent. A strong narrative creates a peak on the first day of trading, but profit-taking and realistic earnings reports always force a correction in the following months. If you are an ordinary investor who cannot afford a 30% drop in your portfolio, buying the stock at the opening bell carries too much risk. This decision tree shows a safer route for retail investors who want to own the company long-term. If you plan to hold the stock for 10 years, your safest move is to wait 6 months. Let the day-one buyers take the initial hit. Give the market 2 to 4 quarters to process the insider dumping and deflate the hype premium. By waiting for the inevitable post-IPO dip, you can acquire the exact same asset at a valuation that mathematically protects your downside. Great companies only make great investments if you buy them at the right price. SpaceX is pricing in a future that hasn't happened yet. Protect your capital and let them prove the math first.